Hey guys, tax law guy here. Tax attorney Josh Sells, another episode of Tax Law Guy. And today we're going to talk about Susan. That's right, Susan, the real estate agent. So we're going to find out how can we take Susan's tax bill. Okay, she pays about $20,000 a year in tax. How can we cut that down over half? Okay, what can we do for Susan to effectively cut her tax bill in half? So we're going to talk today about tax planning strategies for real estate agents. Tax planning strategies for real estate agents. You're probably paying too much in tax if you're in real estate. This is going to help you. Get your pen and paper out. We're going to get into some of the best strategies for real estate agents, how to reduce that tax bill. All right, let's get into it. All right, so here's the story. Susan is a real estate agent. She's single, no dependents. She's an Ohio real estate agent. This is kind of based on a semi-true case. I've altered the facts just a little bit. But Susan's an Ohio real estate agent, and she's pretty good at what she does. Obviously, 2020, 2021 have been hot for real estate. Okay, so lots of transactions have been occurring with our real estate friends. So Susan gets, we'll say, about $110,000 a year in commissions. Okay, so her 1099 at the end of the year for her real estate business is $110,000. Not a bad year. Susan also has $10,000 of other income. Maybe she does BPOs, okay? Maybe broker price opinions. Maybe she has some other income sources. Maybe she has some income such as selling digital assets or some kind of consulting. Nonetheless, she has about $10,000 from other income. Susan also has about $10,000 in losses. Okay, so just important, not necessarily. Important where it came from necessarily for what we're doing today, but let's just assume she has about $10,000 in passive losses. Maybe it was rental real estate, maybe it's some kind of partnership that she's involved in, but nonetheless, she has about $10,000 in passive losses. And her actual business expenses, so not counting mileage, her actual business expenses would be about $20,000. Okay. So whether that's postage, office expense, gifts for clients, about $20,000, and her annual mileage is about 15,000. Okay, not dollars, but miles. Obviously, she's a real estate agent, drives around quite a bit, so she does have that mileage. Susan does her tax work. Okay, so she gets her tax return done, and on her 1040, it shows, based on the facts I just presented to you, she owes about $20,939. Okay, so Susan had $110,000 of commissions, about $20,000 of expenses, and wow, she just got whacked with over 20 grand owed on her 1040. Okay, that's not a small amount of tax. That's a huge tax bill. Well, what's driving this is self-employment tax, right? So she is considered self-employed for federal income tax purposes, and so Susan is paying the full 15.3%, roughly. It's a little shy of 15.3% because of how the calculation works, but Susan's paying basically 15% in self-employment tax on top of her federal income tax. She's probably in the 22% income tax bracket. And so she's paying to over $20,000 in federal income tax based on that fact pattern. That's enormous. That's a huge amount of tax. Susan, what are you doing? You don't have to pay that much. Let's figure out what we can do for Susan, because I think we can help her out. All right, so number one, Susan comes, let's say she comes to my office and she says, hey, I need help. I don't want to pay $20,000 a year. Susan, you're in luck. You don't have to. So step number one, Susan forms an S corporation. So let's assume she already had the LLC formed. Okay, we'll just call it Susan Real Estate LLC. And again, we won't spend a lot of time going into LLC versus a corporation or whatnot. But LLC, a single member LLC, absent any other elections, is taxed as a disregarded entity. So for tax purposes, Susan made the LLC, formed the LLC in Ohio, and for tax purposes, nothing happened. Okay, it's a disregarded entity. So we take that LLC and we file an S election. We tell the IRS that effective January 1st of this year or next year, whenever we want it to start, we want Susan to be taxed as an S corporation. Okay, so we're basically just making an election that the IRS will respect that Susan's LLC will be taxed as an S corporation for federal income tax purposes. We also established that Susan's going to receive a reasonable salary. And again, we're not going to dive into what that means, but let's just say, just for the sake of this illustration, we say that Susan's salary is going to be set at $30,000. Susan is literally going to be an employee of her S corporation. Okay, she's going to be an employee shareholder, an employee owner, if you will. And as an employee, she'll receive a salary. She's going to get a W-2 at the end of the year. She's going to have payroll withholdings, the whole kit and caboodle. Okay, so we set up the S corporation. We put Susan on a salary of $30,000 a year. Just let me add that doesn't mean she's only limited to $30,000 a year. That's just what we're saying is her salary. She's absolutely free to transfer from the business checking account into her personal checking account at any time, as long as the cash flow allows it. Those are distributions. That would kind of be like a dividend, if you will. It's not a dividend in the technical sense, but just to understand what that would be, that's kind of like what it would be like. And again, that's called a distribution for tax purposes. So we set up her S corporation, and lo and behold, let's say that's the only thing we did, right? At the end of the year, her 1040, based on the fact pattern that I just gave you, okay, would be $10,921. So we went from a 1040 of $20,939 down to a 1040 of $10,921. We literally cut it in half just by forming the S corporation. Now keep in mind, on that $30,000 salary, the S corporation paid about $2,300 in payroll tax for IRS purposes. And Susan also had about $2,300 of Social Security withheld from her paycheck as well, her cumulative paychecks, if you will. So even though her 1040 is cut in half to $10,900, the net change is roughly $5,000. She went from $20,000 down to about $15,000 in actual tax spent. Still not bad. We just saved Susan $5,000 just by filing an election and running payroll. What if we did something else? We said Susan had mileage, right? Well, remember, that's her mileage. That's her personal mileage, not the S corporation. Whereas before she was able to deduct her mileage, she's not able to deduct her mileage anymore. It's not all lost, though. We can set up what's called an accountable reimbursement plan. What that means is the S corporation will reimburse Susan for her mileage, tax-free. So it's kind of like if you have a job and maybe you spend something for your employer, or maybe you have mileage and your employer reimburses you. That's not taxable income. It's a reimbursement to you. Now the business gets to deduct those reimbursements, and that's what's going to happen with Susan's S corporation. So she had 15,000 miles, right? Business miles, well documented. She has a log for those. So we're going to reclassify about 15,000 miles. So at about 56 cents a mile, you're looking at about $8,000 of reimbursement. Okay, we're going to reclassify that as a reimbursement, bringing down the S corporation's income. And then we're also going to say that, hey, Susan, she uses her home office. And just without getting into it, that's about $2,500 a year is what we calculate that home office deduction to be. So just by having Susan set up an accountable reimbursement plan, she's going to be reimbursed for her home office, and she's also going to be reimbursed for her mileage. Just those two additions is now going to bring her 1040 down to $8,996. So remember, we started at $20,939, dropped it down to $10,921, and now we're going to drop down even more to $8,996. So we're well over the halfway point. Susan will now have a tax return of about $9,000 roughly. So let's not stop there. Let's add something else. What else can we do for Susan? Well, she was paying health insurance. Okay, she pays about $3,000 in premiums, and she was paying for that out of her personal checking account. Not a problem. She was able to deduct those premiums as a self-employed individual. But what we're going to do now, we're actually going to have Susan pay those premiums out of the business checking account. Now we'll have a separate discussion on another episode about how to do this and what's really happening. But you can actually pay your healthcare premiums for this kind of situation as a business expense. So Susan does that. She takes those $3,000 in premiums and uses her business checking account to pay those. So now what happens to her tax bill? Well, her 1040 went from $9,000. Now it's going to go down to $8,500, just about $8,500. She saves about $500 more in taxes just from adding the healthcare premiums as a business expense. And again, there's some behind-the-scene transactions that have to occur here as far as how these are documented. We don't have time to get into that for purposes of this episode, but just understand that there's a little bit more involved in it here. Nonetheless, she saves about $500 in tax. Now, with Susan's healthcare plan, she has about $3,000 out of pocket. And her healthcare plan is a high deductible healthcare plan. And so we advise Susan to set up an HSA. Okay, she's eligible for it, a health savings account. And so instead of paying that $3,000 out of pocket, she now funds an HSA. And she takes it a step further. She pays it out of her business checking account. Now, the same logic applies. She would still have to do some of those behind-the-scene transactions, putting that on her W-2 as income, and then also deducting it on as an additional expense on her 1040. Nonetheless, this is going to add an additional $500 reduction in her 1040 tax, dropping her down to $7,900. So we started with a tax bill on her 1040 of $20,939, formed the S corporation and established payroll, dropped her down to $10,900. We created the accountable plan and established a reimbursement for her home office and mileage, dropping her down to almost $9,000. Added her healthcare premiums as a business expense, dropping her down to about $8,500, and now established the HSA and had her business fund $3,000 into her HSA, dropping her down to about $8,000. So we went from almost $21,000 down to $8,000 on that 1040. Susan has some extra cash flow now, of course, she's paying less tax, so we advised her to open a 401k, establish a 401k. And you may be saying, well, I thought that was just for big companies. Not anymore. A lot of companies like Guideline will work with folks like Susan and establish a solo 401k, or if you maybe have employees, a standard 401k, a safe harbor 401k is what we advise. And so Susan does that. She opens a 401k and she contributes personally $5,000 as a payroll deduction, and she has her S corporation contribute an employer contribution of $5,000. So you're looking at about $10,000 that goes into Susan's 401k. That will result in a reduction of her 1040 from, we were at $7,900 down to $5,900. Saves almost $2,000 in tax. So Susan's tax bill is now at $5,900. Well, let's go a step further here. I mentioned that Susan had some passive losses, about $10,000. Let's assume she wasn't able to use those. And again, we don't have time to get into the passive loss rules, active participation, material participation, all of that. Let's just assume she wasn't able to use those passive losses. I mentioned she gets about $10,000 from income, such as doing BPOs or selling digital assets. So let's assume that we also formed a second S corporation, or maybe just a second LLC, if you will, and we aggregated all of that seemingly passive income into that LLC. And maybe she has streamlined her BPO process, and she does not spend that much time in it, and we're able to consider that extra $10,000 as passive income. Well, if you have passive income, and by the way, passive income, that could be, again, doing BPOs where you're not spending your time, maybe you're outsourcing that. If you have any kind of e-commerce that uses a fulfillment mechanism, like selling on Amazon, that can be considered passive income. Now, we don't have time to go into the criteria for that. But let's just assume that we're able to say about $10,000 is actually passive income. And now we free up those passive losses. So $10,000 of income, $10,000 of passive losses, those are going to cancel each other out. Maybe she's considered a real estate professional. Probably is. She's a real estate agent, right? Maybe she has rental income and has a tax loss for her rental entities. There's a possibility there too that we could use those losses. Again, there's a lot that has to go into that analysis. Nonetheless, let's say that we are able to utilize those passive losses. That's going to drop Susan's tax bill on her 1040 down to $43.90. So she was at about $6,000 when we did the 401k. And now we offset with those passive losses. She's now down to $43.90. Now finally, number 7, Susan, she's eligible just because of where her adjusted gross income is, even though she has the 401k. She wants to max out a traditional IRA. Now, we're not here today to discuss the pros and cons of traditional IRA versus Roth IRA, but let's say she wants to do the traditional IRA to get the tax benefits now. And so Susan puts $6,000 into a traditional IRA, and again, her adjusted gross income makes her otherwise eligible, even with the 401k that she opened up. That's going to drop her 1040 tax bill down to $3,670. So let's see what happened here. We started at $20,939 in tax on her 1040, and we ended at $3,670. That's a difference of over $17,000. What would you do with $17,000 every year? Well, Susan funded some of her retirement, added an HSA, and still had cash left over. So remember, she is still paying the business portion of Social Security and her own Social Security, if you will. So her net savings from this example is almost $13,000. Okay, so even though her 1040 dropped to from $20,000 down to $3,600, still a great drop. The net difference is almost $13,000. So that's how we help Susan save over $12,000 a year in taxes. And so at 1040 time, when she goes to file her 1040, there's no sticker shock anymore. She can manage the $3,600. So if you're a real estate agent, or maybe you're in e-commerce or some other form of self-employment, there is a lot of tax planning strategies that are available for you. And it's not as complicated as many people think. So if you want to keep paying $20,000, then don't do anything. Keep doing what you're doing. But if you are interested in doing some advanced tax planning, then definitely look at an S corporation. I hope this was helpful for you. A lot of our friends are real estate agents, are friends with the law firm here. We work with a lot of real estate agents, and that's the number one question that we get from our real estate agent friends is, how can I lower my tax bill? So an S corporation has to be part of that discussion. All right, that's all for today. Thanks for watching Tax Law Guy, and we'll catch you on the next episode.